Okay, so if we list these budgets, three main components, and then decompose it into even more detailed boxes here, it will look like this. Okay, so the upper portion here, operating budget, again, it goes back to all the accounts from an income statement. Okay, so we will start off from sales budget. Set a plan for future sales. What is the cash sales that we're getting? What is the accounts receivable sales that we're getting? So why do we start from sales? Why do you think we start from sales? What you receive after carrying out the plan. And also on an income statement, it's the first line, right? That's one of the reasons. And also remember that sales links to pretty much all the other components. You have to first sell products to customers, then you know what is cost of goods sold expense, right? Cost of goods sold expense is always, in the transaction, is recorded together as sales. After cost of goods sold, you may need to do more purchases because customers purchase a portion of the inventory, so you also need to plan what is your potential inventory level next season. Okay, so you need to do budgets on cost of goods sold together with sales. Usually we estimate a percentage of sales as cost of goods sold, planned cost of goods sold dollar amount. Then we estimate purchases. Do we have to make additional purchase in next season? And then what is our ending inventory level? Then from the first two boxes here, based on sales, again, we need to hire people, we need to rent places, so you have rental utility, you have depreciation on expenses incurred for long-term assets on the facility. All of these factors in operating expenses. All the additional expenses that are not covered in the second box. Okay, so at the end, if we link first three boxes together, that gives you the entire budgeted income statement. So the first four boxes here relates to operating budget. At the end, the goal is to get to an anticipated income statement. Okay, now, after doing that, then we consider a capital expenditure budget. This relates to long-term assets purchase, long-term assets trade-in receipts. Any of the cash that we received, any transactions on long-term assets purchase or selling goes into this budget box. The remaining three financial budgets captures all the other information that we haven't captured in operating and capital expenditures. So we'll start from cash budget. Cash, again, is the most important of the entire financial budget. Remember, balance sheet starts from cash account. It's the most important asset in the business. Then we go on to budget the entire balance sheet, putting together all the assets, liability, equity information. Then at the end, statement of cash flows. Okay, so this entire structure is very important in budgeting. Basically, it's the same structure as we do the actual financial statements. Remember, financial statements and financial accounting, we start from income statement, then we transfer net income into statement of retained earnings, which then is transferred to balance sheets, part of equity. After balance sheet, then we do statement of cash flows because statement of cash flows looks at all three statements, cash inflow and outflow. Right, so this entire budget structure is important to know, and actually it mirrors financial statements structure and process.